From the heart of the nation's capital, this is the Evening News. Breaking news starts now.
At 9 in the evening Eastern Time tonight, the global financial system will reveal whether it is still in control or already in retreat. The trigger is not a war declaration, not an election, not a central bank speech. It is a sudden, aggressive decision by the Chicago Mercantile Exchange to raise precious metal margin requirements twice in 72 hours. Just days after silver suffered its largest one-day collapse in recorded history. This is not a routine market adjustment. This is the clearinghouse equivalent of slamming the brakes while the engine is already overheating. And the target is specific: leveraged exposure to gold and silver at the exact moment physical metal is becoming hard to find. Let that sink in. Silver collapsed by more than 30% in a single session, a statistical outlier so extreme that Reuters described it as one of the sharpest declines ever recorded in modern metals trading. Within hours, CME announced a margin hike. Then another. Gold margins jumped by roughly 1/3. Silver margins by more than 1/3 again. Platinum and palladium followed. The official explanation was risk management. The timing says something else. According to Reuters and the Economic Times, the margin increases were enacted after extreme volatility, with clearing members demanding additional protection against cascading defaults. That language matters. Clearing members do not panic unless someone, somewhere, is failing to meet obligations. This is where the story stops being about price and starts being about systemic stress. Because margin hikes do not punish volatility. They punish participants. Specifically, they punish anyone using leverage who cannot instantly produce cash. That forces liquidation, regardless of conviction, fundamentals, or long-term positioning. In other words, paper markets are being forcibly de-risked, while physical markets are screaming scarcity. That contradiction is the core of the crisis. While futures prices were collapsing in New York and Chicago, physical silver across Asia was trading at massive premiums. In Shanghai, spot silver hovered more than 40% above COMEX levels. On Chinese retail platforms, physical silver bars were listed at nearly double United States futures prices. These are not fringe numbers. They reflect a structural divergence between financial price discovery and real-world supply access. Mainstream financial media has acknowledged the volatility, but has not fully confronted the implication. You cannot have collapsing paper prices at the same time dealers struggle to source metal, unless one of those markets is lying. This is not the first time this has happened. During the pandemic panic, futures markets crashed while bullion dealers shut down sales entirely. Premiums exploded. Delivery times stretched into months. The paper market said, sell. The physical market said, there is nothing left to sell. We are seeing the early contours of that same fracture again, but this time with a crucial difference. The macro backdrop is far more fragile. The United States Federal Reserve has already cut rates aggressively since late 2024. Financial conditions have loosened to levels last seen before the inflation shock. Credit spreads are tight. Asset prices remain elevated. And yet, the system is reacting to volatility as if it cannot tolerate another shock. That tells you something important. It suggests the margin hikes are not about metals. They are about containment. Because silver did not fall in isolation. Equity futures dropped sharply. Cryptocurrency markets weakened into the weekend. The United States dollar, despite recent strength, faces historic bearish positioning according to options data cited by major financial outlets. At the same time, geopolitical risk is rising. The Middle East is heating up again. United States naval deployments have increased. Iranian leadership has issued explicit warnings that any strike would trigger regional retaliation. That matters because precious metals are not just commodities. They are geopolitical assets, hedges against monetary disorder, war risk, and institutional credibility loss. And yet, the very institutions tasked with maintaining orderly markets are now aggressively squeezing those hedges through margin pressure. Ask yourself why. If the system were confident, It would allow volatility to resolve naturally. If liquidity were abundant, it would absorb the shock. If balance sheets were strong, it would not need emergency buffers. Instead, the response was immediate and blunt. 2 margin hikes in 3 days is not normal. It is defensive, and defense means someone is exposed. Reuters noted that large institutional players rapidly adjusted positions during the crash. Analysts tracking futures data observed that major banks reduced short exposure near the lows. That suggests sophisticated players exited, while the forced selling fell on smaller, leveraged participants. That pattern should concern anyone who believes markets are neutral. Because when clearinghouses raise margins into a crash, they are choosing winners and losers in real time. They are deciding who gets to stay in the game and who is expelled. Now zoom out. Asian markets open first: Shanghai, Hong Kong, Tokyo. They will trade before the United States futures market reopens under the new margin regime. If physical prices in Asia hold firm while New York remains closed, it will expose the gap even further. If they collapse in sympathy, it signals global deleveraging. Either outcome is destabilizing. This is why tonight matters more than any headline this week. Because this is no longer about whether silver goes up or down tomorrow. It is about whether paper markets can still dictate reality when physical demand, geopolitical risk, and institutional fragility are all moving in the opposite direction. The system just flinched. The only question left is whether that flinch was the start of a controlled retreat, or the first visible crack in a structure that has been under strain far longer than anyone has admitted. And if the paper market loses credibility here, what collapses next? The next escalation is already forming, and it does not start in New York. When Asian markets open tonight, they are not reacting to Wall Street. Wall Street is reacting to them. That inversion matters. For decades, the United States and its futures markets dictated global price discovery. New York set the tone. Chicago enforced it. Asia followed. But the current crisis is unfolding in reverse order, and that alone signals a shift in power. Because Asia opens while the American paper market is still locked behind newly raised margin walls. Shanghai, Hong Kong, and Tokyo will trade unconstrained by CME's emergency controls, pricing metals not as financial derivatives, but as economic necessities embedded in manufacturing, savings, and geopolitical strategy. This is where the conflict becomes geopolitical rather than purely financial. China does not treat silver and gold as speculative assets. It treats them as strategic inputs. Silver feeds solar infrastructure, electronics, military supply chains, and export manufacturing. Gold functions as a monetary anchor in a world where trust in fiat systems is increasingly conditional. So when silver trades at deep discounts on United States futures exchanges while physical premiums in Asia explode, it sends a message Beijing understands clearly. The Western pricing mechanism is unstable. That is why the Asian Open tonight is not just another trading session. It is a referendum. If Shanghai silver prices hold near recent elevated levels, or even rise, while COMEX remains shut, the illusion of a unified global price collapses. 2 markets. 2 realities. One cannot survive intact. This is not speculation. Reuters and Business Insider have repeatedly noted that Asian demand, particularly from China and India, has been the dominant force supporting precious metals during periods of Western liquidation. That demand is not leveraged. It does not face margin calls. It is price insensitive when the motivation is security, not yield. Now layer in the macro stress signals. The United States equity market is wobbling. Futures are down sharply. Volatility indexes are elevated. Liquidity-sensitive assets are under pressure. Bitcoin, often treated as a barometer for speculative appetite, failed to reclaim key psychological levels over the weekend. That failure matters because Bitcoin has become collateral in the modern financial system, not officially, but functionally. When it weakens, leverage contracts elsewhere. This is why margin hikes in metals ripple outward. Clearinghouses do not isolate risk. They transfer it. As traders scramble to meet higher margin requirements, they liquidate whatever they can: equities, crypto, bonds, even cash-like instruments. That forced selling tightens financial conditions instantly, regardless of what central banks intend. And here is the uncomfortable truth. Central banks are losing control of sequencing. Rate cuts were supposed to ease conditions gradually. Balance sheet discipline was supposed to restore credibility without triggering shock. Instead, the market is experiencing liquidity whiplash, loose conditions on paper, tightening conditions in practice. That contradiction is unsustainable. Now consider geopolitics. Middle Eastern tensions are not background noise, they are catalysts. Oil markets are tense, shipping lanes are vulnerable, military rhetoric has hardened. Any escalation overnight, any missile strike, naval incident, or breakdown in diplomacy will immediately collide with already fragile markets. Historically, that would trigger a rush into gold and silver. But what happens if the paper market cannot absorb that demand because it has been structurally constrained? That is the scenario no one wants to discuss openly. If futures markets fail during a geopolitical shock, not through closure, but through dysfunction, confidence in Western financial infrastructure takes a direct hit. Not a temporary hit, a structural one. And confidence, once lost, does not return quickly. This is why Asian behavior tonight matters more than American commentary tomorrow. Asia is not over-leveraged. Asia is not scrambling for margin. Asia is not managing quarterly performance metrics. Asia is accumulating. That accumulation does not need to be loud. It does not need headlines. It only needs persistence. And persistence, over time, breaks pricing models built on leverage and rollover assumptions. The irony is brutal. Western institutions are raising margins to protect stability. But by doing so, they may be accelerating the migration of price discovery away from their control. Because if the world concludes that futures prices no longer reflect access, availability, or trust, then futures become theater. And theater collapses the moment the audience stops believing. The deeper issue is this. The global system was designed for a world of excess liquidity, predictable geopolitics, and unquestioned dollar dominance. That world is fading. Now we have fragmented power, contested trade routes, weaponized finance, and populations that no longer assume institutions will protect them in a crisis. In that environment, physical assets regain political relevance, not as investments, as insurance. That is why the current standoff is so dangerous. Because if tonight's Asian session confirms that physical markets are decoupling from Western paper constraints, the implications extend far beyond metals. They reach into currencies, debt markets, and the credibility of the post-war financial order. The system is trying to discipline volatility. But volatility is no longer the threat. Loss of control is. And the next phase of this crisis will not be decided by charts or commentators, but by how institutions respond when their tools stop working the way they used to. The question is no longer whether the system can absorb another shock. It is whether it can survive the realization that the rules it depends on are being quietly rewritten, somewhere else, while it sleeps. By the time the United States wakes up to Monday morning, the most important decisions may already be made. Not by traders, not by politicians, but by systems reacting to stress faster than humans can intervene. This is how modern crises unfold. They do not announce themselves with crashes alone. They announce themselves when institutions stop explaining and start reacting. The margin hikes, the forced liquidations, the silence around physical shortages, the nervous insistence that this is just volatility. Those are not explanations. They are symptoms. Because what we are witnessing is not a pricing anomaly. It is a credibility test. And credibility, once questioned, becomes the most expensive asset of all. For decades, The global financial order rested on a simple assumption that paper claims were as good as physical reality because institutions stood behind them with infinite confidence, infinite liquidity, and unquestioned authority. That assumption is now being quietly renegotiated, not through speeches, not through reforms, but through behavior. When clearinghouses raise margins twice in 3 days, they are telling you something without saying it out loud. The system does not trust its own participants to remain solvent under current conditions. When physical markets trade at extreme premiums while paper markets collapse, they are telling you something else. Price is no longer the same thing as access. And when geopolitical tensions rise simultaneously, not hypothetically, but operationally, the margin for error disappears. Because in a world of fractured trust, people do not wait for confirmation. They act preemptively. That is why the real danger is not a single market move, or even a single weekend of chaos. The real danger is behavioral change. Once participants begin to believe that paper markets can be suspended, constrained, or distorted at moments of stress, they stop relying on them as anchors. They shorten time horizons. They demand immediacy. They favor possession over promise. That shift is subtle at first. Then it accelerates. History shows this pattern clearly. Every major monetary transition begins not with collapse, but with workarounds. People do not rebel against the system all at once. They quietly reduce exposure. They diversify away. They hedge outside official channels. That is how parallel systems form. And parallel systems are how dominance erodes. The uncomfortable truth is that Western financial infrastructure is optimized for speed and scale, not resilience under geopolitical fragmentation. It assumes cooperation, predictability, and rule adherence. But the world is moving in the opposite direction. Trade is weaponized. Currencies are politicized. Supply chains are regionalized. Security is prioritized over efficiency. In that environment, assets that cannot be printed, paused, rehypothecated, or margin called gain strategic value. That does not mean prices rise in straight lines. It means importance shifts quietly. This is why attempts to frame the current turmoil as a temporary metals correction miss the point entirely. The metals are not the story. They are the signal. They are exposing stress fractures between financial engineering and physical constraint, between institutional confidence and public skepticism, between declared stability and actual fragility. And here is the part that should unsettle everyone, regardless of ideology or investment preference. If institutions are forced to choose between preserving market order and preserving institutional solvency, they will choose themselves every time. That is not corruption. That is survival. Which means rules will change when pressure rises, not transparently, not democratically, but operationally. Margin hikes, trading halts, liquidity controls, narrative resets, all legal, all justified, all destabilizing if trust is already thin. This is where geopolitics re-enters the frame, because other powers are watching closely. They are not focused on silver prices or futures spreads. They are studying institutional reflexes under stress. They are asking whether Western systems still project inevitability or merely habit. And if the answer tilts toward habit, then the balance of power shifts faster than anyone expects, not through conquest, through substitution. The future does not belong to the loudest system, but to the one people quietly prepare for when things go wrong. That is the lesson of every transition period in history. Empires do not fall when markets crash. They falter when belief becomes conditional. And belief, right now, is being tested across every layer of the global order, financial, political, and strategic. So here is the larger message that cuts through all the noise. This moment is not about predicting Monday's price action. It is about recognizing that the mechanisms designed to absorb shock are themselves becoming sources of shock. Once that happens, volatility stops being cyclical and starts being structural. Which brings us to the question that will define the next phase, not just of markets, but of power. When institutions tighten control to preserve stability, and in doing so accelerate the loss of trust, are they protecting the system, or revealing that the system no longer believes in itself? That is not a market question. It is a civilizational one, and the answer will not come from charts or headlines or official statements. It will come from where capital, confidence, and people choose to stand, before they are forced to move. Thank you for listening. Before you step away, share your perspective in the comments. If you found this breakdown valuable, hit like and subscribe, then turn on notifications so you don't miss the most critical political developments as they break, day after day. See you next time.